Hey everybody, John Savarino here, and this is Talking Money. Today's video, we are going to be talking about the difference between short-term capital gains versus long-term capital gains and how the way that they are taxed is distinctly different. Now, before we get into today's video, I just want to make it very clear. If you're watching up to this point, please hit that like button. It's no secret. We're getting 40 to 50 views on these videos, but we're only getting 3 to 4 likes. So once again, do me one favor. If you're watching up to this point, hit that like button. If you say to yourself, I can't hit that like button, leave me feedback via a comment below on why we don't deserve that like. Now, back to the video, short-term capital gains versus long-term capital gains and how they are taxed is distinctly different. Today's video is only going to be related to taxable money. If you're not sure what I'm talking about there, I highly suggest going back to an earlier video I did called How's My Income Going to Be Taxed in Retirement, where we talk about the 3 tax buckets. So this video is going to be in reference to that taxable bucket, as you can see above, not the tax-deferred bucket or the tax-free bucket. Once again, just the taxable bucket, aka non-qualified money. Now, a short-term capital gain is going to be a gain on a position, such as a stock or an ETF, that I've owned less than a year, or actually a year or less. So whether I owned it for 365 days or I owned it for 364 days, that gain is going to be considered a short-term capital gain. A long-term capital gain is going to be just a gain on a position, such as a stock or an ETF that I owned longer than a year. So if it was 366 days or longer that I own this position, it's going to be a long-term capital gain. And the way that those are taxed is distinctly different, as I said previously. On a short-term capital gain, for example, that's going to be taxed at ordinary income rates. So the example I'll give you is if I had $100,000 of taxable income and I had short-term capital gain, that short-term capital gain is going to be taxed at 24% based on where I fall tax-wise as a single person. If I had taxable income of $100,000 as a married filing joint couple, well, same concept applies, except I would be taxed at a 22% tax rate, since that's where I fall on this marginal tax rate table. Now, on the flip side, though, let's say I had some long-term capital gains as a single person at $100,000 of taxable income in that year. Well, I would get quote-unquote special tax treatment. So instead of paying 24% on my long-term capital gain, I'm going to pay capital gains rate of 15% on that long-term capital gain. So it's a distinct difference between the two, and you should be considering that when discussing things with your CPA and how your non-qualified portfolio is built out, long-term versus short-term, because the way that they are taxed is distinctly different and can impact your bottom line in a big, big way, also giving up opportunity cost if you're not sure between the two of them. So once again, today we discussed short-term versus long-term capital gains and how they are taxed differently in a very distinct way. Once again, if you like this video, please hit that hit that like button below. If you can't hit the like button, then please leave some feedback via a comment below and let us know why. If there's certain topics, questions that you have that you want us to be answering on one of the future videos that we do, then please let us know. And as always, we'll talk money soon.